Welcome, everyone. I'm Angelo Robles to the Angelo Robles podcast. I'm also the founder and CEO at Family Office Association. To give a little context to our discussions, I help global families and their family offices solve problems, procure positive future outcomes, and prepare for intergenerational necessity. It's vital for families and their family offices to understand their vulnerabilities and become more resilient so they can mitigate risk and prevail during times of crisis. My experience with some of the wealthiest families in the world has allowed me to distill best practices for discovering purpose and refining vision, governance, structures, systems, processes, and culture that successful families and their safeguard family offices need in order to thrive. I help families create or reinvent their family office to be of institutional quality and highly adaptive. Our session today is What's Next for Emerging Markets. It features Arjun Divecha, head and founder of GMO Emerging Markets Equity Team. He is also a member of the GMO Board of Directors. Prior to joining GMO in 1993, he spent 12 years at Barra directing software development, marketing, client services, emerging markets research, and development. He holds a bachelor's degree of technology and aeronautical engineering from the Indian Institute of Technology, Bombay, and an MBA in finance from Cornell University. Arjun, welcome to the show.
Thank you. Thank you very much, Angelo.
Well, it's a pleasure to have you here. We've never been more global, meaning me and what I do, than during COVID-19, actually becoming digital and doing 200 digital events a year has reached a much, much more broader, diverse audience. In many ways, it's been wonderful for me. And I'm always reminded that, in my opinion, I think American families of great wealth, $50, $100 million and up, probably tend to be overly concentrated in developed markets and the US. It's a pattern I've seen going back to when I launched FOA 13 plus years ago. I think they're just starting to wake up, although I did say that a couple of years ago, to the opportunities occurring around the world. Perhaps you could argue other developed markets, but probably more so emerging and frontier markets. Why don't we start? And I know this sounds a little basic and foundational, but I think it's important. So, Arjun, a question I have for you so our audience could understand, and I'm simplifying it a little bit, but there's developed markets, emerging markets, and frontier markets. You're going to be much more focused on emerging and frontier markets. How is that defined?
So basically, back in the old days when I first started out in the early 90s, the distinction was countries that had a per capita GDP of $10,000 or less were considered emerging, and the ones with $10,000 per capita GDP or more were developed. That definition has kind of evolved now more to basically having to do with market access, wealth levels, how easy is it for foreigners to buy and sell into the market, and things like that. And so that's why we now have these three distinctions, and the distinctions are largely made by the index providers like the MSCI and people like that. But quite frankly, I have my own kind of definition of emerging markets, which is quite different. And that is that my belief is that the difference between an emerging market and a developed market is that in an emerging market, there is always a non-trivial probability of catastrophic loss. And that to me is the real difference between the two.
That's a big difference.
Yes.
So there's various regions, all the regions of the world that are going to have emerging and frontier markets for the most part. Sure. I would think of Asia, Southeast Asia, LATAM as probably being the big two in those markets that come to mind. I'm assuming Africa is going to be as a continent more in the frontier markets. We may have a chance to get to a little bit of that. And I'm assuming there are still some emerging markets in Europe. So we have lots to cover, but why don't we begin with Asia? Because I think there's just using some of the numbers. So one of my families did a thesis that basically said, we have so much capital basically chasing in North America, ballpark about 400 million people. If you go to Southeast Asia, ex of China, there's about 4 billion people. There just is and as they're starting to gain in wealth and resources, those are emerging markets that are probably very volatile, but they create opportunity. If you could talk a little bit about that region, and then maybe we'll narrow down to some specific countries.
Sure. So, I mean, the big elephant in the room is always China, because it is much bigger than everybody else, almost pretty much in terms of the size of the markets. The Chinese equity market has a market cap of about $8 trillion. And that is, probably the second biggest market in the world after the US. So it's way bigger than other countries like Germany or Japan or even or the UK. So in many ways, the opportunity set is kind of looking at China and looking at all the other countries. And you're absolutely right that, at the end of the day, these are basically countries that are getting richer. And so therefore the opportunity set is obviously getting better and better. But from an investment point of view, the way we look at the world is basically that you obviously want to invest in countries that are doing well and things are getting better. But at the end of the day, in order to make money for our clients, you have to focus not just on the underlying reality, but also on what is the market paying for them. And so valuations obviously matter a lot. And so when we look at markets, we look at the combination of, is the country cheap? What is the price you're paying to get into that country? And what are the prospects, and is the government doing the right thing in those countries? So basically, that's how we look at things. So for example, if we look at the Asian markets right now, China doesn't look that attractive to us, primarily because it's gone up a lot this year. So if you go back to the beginning of this year, we had quite a lot of money in China because it was quite attractive. But once the crisis, the pandemic basically hit, what happened is that the Chinese market actually held up extremely well. And in some sense, because the economic disruption in China has been so minimal, the market has gone up a lot. So the Chinese market, depending on which aspect you look at, is up between 20 and 25% this year, whereas a number of other countries have done really poorly. So again, those countries may not be doing as well from a COVID point of view, but the valuations have become far more persuasive. So we have more money over there. So we've moved money away from China, into some of the other countries like Indonesia and Thailand.
And actually, on that note, staying in that region, what are some countries that you're seeing opportunity as things are playing out that you're being active investing in?
So one of the countries that we like a lot, again, it's very difficult to invest large amounts of money in, is Vietnam. Vietnam is a country with a relatively large population, about 100 million people. What's surprising about Vietnam is that it's very high education based, something like 99% literacy, and is doing an extremely good job of basically, moving forward. And in fact, if you think about the world from a point of view of the tensions between the US and China, which we believe are going to persist no matter who wins the election. I think irrespective of what happens in the US election, there is going to be more and more of an economic decoupling between the US and China. So one of the questions we think about is who benefits from that? Who are the beneficiaries who can take market share away from China? And the three countries that we tend to like the most right now are Vietnam, Bangladesh, and Thailand. Those are the three countries that tend to benefit the most. So, I mean, just to give you an example, Samsung has already moved all of their cell phone production out of China and into Vietnam. So Vietnam is kind of where pretty much the bulk of all the cell phones that Samsung makes are produced. So we're seeing that, that kind of trend occur.
Yeah, that's tremendous. And I mentioned to you offline that we have a very successful global billion-dollar family that in our private mastermind series of families only last week highlighted some of those key points about Vietnam that you're making, although they're doing it in private industry, which is more risky, but potentially could be arguably incredibly rewarding. And I think the big thing that you also repeated that they said, people don't realize the education level in Vietnam and that it has 100 million people. There's a perception from Americans, at least, that it's much, much smaller than that. Now, will you say that if there's a further decoupling between China and the US, which appears inevitable, even if it's 5 or 10%, that could cause tremendous potentially positive volatility with opportunities with other countries. You mentioned Vietnam, but that would apply to others as well in that region.
Yes. Yeah. And the point I'd like to make on that is that even if there's a 5% decrease in US-China relations, that 5%, because China is so big, represents a massive increase for somebody else, like a Vietnam or a Thailand or Indonesia. So the fact is that as people move, or especially as US companies move production away from China towards some of the other Southeast Asian countries, and this could be in all areas, from electronics to automobiles to to toys to pretty much everything. That could be a very, very big opportunity for some of these countries. And interestingly enough, it doesn't necessarily have to be negative for China, because what's happened in China is that they have been wanting for quite a few years to really shift the emphasis of the economy away from being export focused to being much more domestic consumption focused. So we think it will accelerate that trend, that domestic consumption. So therefore, when we're looking at investment opportunities in China, we're looking at some of the domestic opportunities rather than the export opportunities, because we see that as being an area which will benefit, again, from this decoupling. So we think it could be a win-win for both the US and China and a bunch of other countries, in the region.
That is true. When I think of EM and all the incredible volatility, and it seems like some well-known countries have been frontier to emerging market for multiple decades, many investors in developed markets have been pretty successful in public equities over the last 10 years, a kind of buy and hold. It simplifies things. It may be more tax advantage. I get it. But COVID-19 did change that. Many families are now becoming more tactical. But in emerging markets, I think it's almost a necessity that if you're investing in emerging market equities, you need to be tactical, meaning strategic, when to get in and when to get out. I don't think it's as easy as buy and hold.
Absolutely. In fact, if I could kind of give you my thesis about investing in emerging markets, basically my view is this. I've spent a lot of time, I've been managing money in emerging markets now for 27 years. And I've spent a lot of time thinking about why is it that some countries are rich and some countries are poor. And what I figured out, while there are 100 idiosyncratic reasons, there's one common factor amongst all the countries that become rich. And that is they build institutions that basically which allow them to grow even in the face of terrible governments. That is, their economic growth is much less dependent on the quality of the government because the institutional nature holds. I think the US is a perfect example of that. I mean, even if you go back to the Depression and you look at the GDP growth of this country, the Depression just looks just like a tiny little blip. Why is that? It's because the institutional nature holds. And that's what I believe, is a great thing for a country like this. However, in most emerging markets, these institutions aren't that strong. And so you basically are very dependent on the government of the day getting it right. And so when we invest in these countries, we have a basic mantra, which is don't fall in love, just date and move your money around. So there's two things, as I said, we focus on. We focus on each country is first and foremost, what is the valuation? What are you paying for it? Because at the end of the day, as a value investor, the one thing we believe deeply is that what you pay for something is the single most important determinant of how much money you will make when you finally get out of it. The second thing that we focus on is what is the government doing in that country right now? That is, are they doing the right thing? Are they running trade deficits? Are they running budget deficits? How are they managing the economy? So we assess both of these, the cheapness and the quality of the government, when we decide what makes for an attractive country. So for example, right now, the country that comes across as most attractive to us, believe it or not, is Russia. And that's because of the cheapness. Yes, the government has all kinds of problems and things like that, but at least it's stable. We don't think there's going to be any regime change. We don't really expect any great change. We don't think of Russia as being a growth stock. We don't think that it's going to grow dramatically. But at the end of the day, the entire market trades at something like 5 or 6 times earnings, pays a dividend yield of 7 or 8%, and is, while it's very dependent on oil, the budget itself is balanced at $40 a barrel. So the point is that even at $40 a barrel, there's no real distress to the government or to the exchequer in that country and its ability to kind of fund stuff.
No, it's great to get your opinions and be so specific in your responses, and I'm sure our audience is loving that. We'll get to some of the micro things that, and you already mentioned some that you look at in making the decisions as an astute investor for 27 plus years, but insights on Vietnam and Russia have already been incredibly helpful. You already mentioned a couple, but let's dive a little bit deeper into your decision-making process, kind of macro type questions to ask when you and your team are looking at a country. I'm assuming things like what are the core industries that make up and drive that economy, and how diversified are they? How is the capital being used in the economy? I'm assuming those are also among probably 15 or 20 things that you look at that are probably towards the top of the list.
Yeah, I mean, you typically start out with the big picture. That is the macroeconomic indicators. That is the country growing or not, first of all? How much is it growing relative to its history? What are the factors of growth? Is it growing because of domestic consumption? Is it exports, things like that? Then you're looking at industrial production. Is industrial production going up or down? Is the budget how much of a budget deficit or surplus is there? Is there a trade deficit or surplus? So we look at a number of indicators like that to basically say, well, is this country's momentum, so to speak, economic momentum on the rise, or is it falling? Because at the end of the day, you want to be betting on countries where things are getting better, coupled with the cheapness, which again, so on that front, when we look at the cheapness, we look at parameters like the price to book ratio, price to earnings ratios, dividend yields, a number of traditional value metrics we look at to decide whether a country is cheap or expensive. Now, you mentioned sectors. Now, clearly, the sectoral composition of a country matters a lot. So, for example, Russia is 60 to 70% materials and energy. Those are the two big sectors in the country. And you should expect that commodity type sectors should trade at a discount to other kind of sectors. So therefore, while Russia is cheap at 5 times earnings, it may not, it shouldn't trade at 15 or 20 times earnings like the US market would trade. Conversely, if you look at a country like Taiwan, which is very heavy in tech, where 70% of the index is in tech companies, you shouldn't expect it to trade at 5 or 7 or 8 times earnings, because tech companies really are much higher growth and therefore should deserve to trade at higher valuations. So you need to take all those things into account when you decide whether a country is cheap or expensive.
And I'm assuming you're looking at even the demographics in terms of the people, the labor force productivity, and even relative to the market function, are there embedded structural features that may limit growth, tariffs, subsidies, et cetera?
Sure, absolutely. Yeah, the last things you talked about are obviously very, very important, which is how open an economy is it and things like that. But you mentioned demographics, and demographics are particularly important. The problem with demographics is that they play out over long horizons. So therefore, they don't play out over a 6-month or a 1 year or even 2 or 3 year horizon. They play out over 5, 10, 20 years. So we take that into account as a baseline, but we're not making decisions on a day-to-day basis based on the demographics. So let's take a long-term demographic trend when we look at India and China. China, interestingly enough, because of the one-child policy, the demographics were terrific all the way from the late 70s till about 2015. Now, because of the one-child policy, you have a situation where the demographics are getting worse. And in fact, if you think about additions to labor force, China has already become negative. That is, basically every year there are fewer people in the labor force than the previous year. And that is going to continue out for the next 30, 40 years. So in some ways, the Chinese demographics get worse. And one of the interesting things that you're seeing as that demographic gets worse, as basically you get an aging population, one very interesting statistic is that the number of marriages in China is basically now decreasing quite dramatically because of the demographic shift. And what does that mean? It means that household formation is decreasing, and therefore you essentially get to a situation where there'll be a fewer demand for houses, And so those are all the things that kind of factor into how you make decisions, Conversely, if you look at India, the demographics actually look quite good. But demographics are not destiny, because if you have a lot of young people without educations and without jobs, that's what leads to revolution. So in India's case, the demographics may or may not, in fact, be positive because of the fact that the education system has not been doing very well. And so you're going to end up in the next few years with a fairly large population of people who are undereducated and are not going to have jobs.
Yeah, we had a military leader on a couple of months back, and a grave concern that they look at, I guess the CIA does too, is especially under 26-year-old males that are unemployed. It's
Yep.
asking for a chaotic situation. We're not going to cover that issue. It's a little bit beyond the scope, but those would be concerns and things that you look at. Uh, I suppose also in other parts of the world, and again, we're unique maybe here in the US, but in certain countries in Southeast Asia, like Korea, a lot of the successful businesses are still family held and owned. So there are nuances in terms of who has power and who has control, how influential are families. And you already touched on it, things that you look for. But in other, I'll be careful how I phrase this because it could happen in every country. But in other countries, there's potentially what we would look at as being political corruption. And how do you know when to get in, when to get out? You already partially answered it, was you look for companies that could withstand that over the course of time, but other insight would be great.
So timing is always a difficult one. It's there's never, and we don't see it as a step function. It's not like we wake up one day and say, "Oh my God, look at Russia, it's so attractive. Let's put a whole lot of money in there." What you do is you have a continuous process where you're evaluating it on a continuous basis. And so on a continuous basis, you're adding or subtracting to each country, based on things improving, getting worse, getting cheaper, et cetera, et cetera. So it's a fairly continuous process. And so our big weight in Russia today didn't happen overnight. It happened slowly over years, in fact. On average, when we tend to own a country, we tend to own it for 18 to 36 months. So again, it's not an in and out. It's not like, okay, we wake up one day and put money in, next day we take it out. You're buying slowly into countries and you're selling slowly out of countries as they become less attractive. Again, you're looking for companies within those countries. And the kind of companies we look for, again, meet a couple of criteria. And again, cheapness, as value managers, cheapness matters a lot. But we focus a lot on something we call the quality of a company. And the quality has to do with kind of three attributes we like to think of. We like profitable companies. So profitability is a metric of quality. Obviously, if you're very profitable, that's a good thing. The sustainability of that profitability, that is, how predictable is profitability? Is it kind of a company whose earnings go up and down every single year, or is it a company who kind of have fairly stable earnings? So that matters a lot. And then finally, the third thing we look for is something we call safety. And safety has to do with things like debt. That is, if you have a lot of debt, well, when bad things happen like COVID, companies with a lot of debt are obviously in much greater trouble than companies that don't have a lot of debt. So those three factors make up what we call quality for a company. So we combine quality with valuation to decide what is an attractive company. So for example, I mentioned Russia. Clearly, stuff is very, very cheap, but the companies themselves are not that high quality. And so therefore the hurdle that they have to get over to get into our portfolio is higher, as opposed to, let's say, a company in China like an Alibaba or a Tencent, which are very high quality companies. So we're willing to pay a much higher multiple for those companies because they're much higher quality.
Yes, indeed. And, just hearing you talk and how complex the global markets are and understanding macro and micro, it'd be very, very hard for even a family office to be an active direct investor, whether in public or privates, unless they have the internal resources and likely some level of boots on the ground, if not in specific countries, at least in various regions. Is it impossible? No. It's possible, but it's very hard. So most of them are going to look to allocate to third-party managers. It's a very competitive market. Why don't I broadly start with, if I'm taking this risk in additional volatility, historically compared to just being S&P in the US, has it proven, am I getting a premium for the risk that I'm taking? I'm assuming it's depending on the manager and the activity of the manager and how they're hedging risk. But is it worth it for me? In general, do you think I would get 200, 300, 400% more basis points comparative to developed market countries?
Well, again, it's very dependent. If you go look back historically, it's very dependent on the time period. So clearly in the last 10 years, especially since the global financial crisis of 2009, emerging markets have done quite a bit worse than the developed markets. And again, and again, I think I'm sure most of the people listening to this are familiar. A large part of that return has come from the FANGs and from kind of some of the the tech companies and things like that in the US. And that's also been true in emerging markets. The equivalent of the FANGs in the emerging markets have also done incredibly well. But if you go back to other periods of time, so for example, between, say, just to give you an example of the years 2000 to 2010, which is the last time when emerging markets were really, really cheap relative to the US, which is where we're at today. Over the next 10 years, in real terms after inflation, the US was down 2.3% a year from 2000 to 2010. Emerging markets were up 12% a year in real terms over that decade as well. And where we're at today is very similar to 2000. That is just like at the end of the tech bubble. The valuation gap between the US and emerging markets is absolutely extreme. That is, we at GMO, we spend a lot of our time basically managing money for clients who we do the asset allocation for, where they give us the mandate to decide how much emerging, how much US, and things like that. And right now, we are very heavily overweight in emerging markets, and we have very little money, in fact, close to zero in the US, given the valuation differentials. As I said, the gap between cheap and expensive in the sense of US versus emerging is about as big as we've ever seen. And that's why we're very bullish on emerging markets right now. And especially even within emerging markets, if you were to kind of make the distinction between the value and the growth companies, that is the equivalent of the expensive versus the cheap companies, that gap has also opened up dramatically, similar to what we had seen back again at the peak of the tech bubble. So we think it's a particularly good time to be a value investor in emerging markets. Now, it has been a particularly bad time over the last few years because clearly value in emerging has done quite poorly relative to having money in the US. But trends don't continue forever. Things will change, and I suspect this will be the place to be. So in the next few years.
And it's hard to be generic, but we'll try. For a family that is willing to accept volatility, has a diverse portfolio, again, a significant family office level family, let's assume they have 30% exposure broadly to public equities. What percentage of that do you think they should have invested into emerging and frontier markets?
I think it depends on the risk tolerance. Obviously, that's very, very dependent on the risk tolerance of the people who are managing the money. I can tell you what we are doing in the portfolios that we manage for our clients, where the broadest mandate that we have is something we call the benchmark free allocation fund. And in that strategy, basically, we currently have only about 40% equities overall. Normally we would have 60-65. So that tells you that we're quite light on equities at this moment because we think equity markets in general are quite expensive. But of that 40-45%, about 30% is in emerging markets. So clearly we are putting our money where our mouth is, because we think it's so cheap. Now I recognize that very few of most family office type operations are not going to be willing to take that big a risk. So I would say put as much as you're comfortable, buy as much as you can, which allows you to sleep at night.
And in terms of COVID-19 and its impact on various countries, we'll go back a little bit to Vietnam. It's a country with near 100 million people. And, maybe the reporting hasn't been perfect, but if I remember off the top of my head, maybe like 20 COVID cases or deaths. So I'm sorry. Are you looking at the challenges companies are facing and how the governments as well as the people are adapting to COVID in some of the decisions that are tactical that you're making?
Sure. So in fact, when the crisis hit, we basically set up a little task force of our own. And what the task force does is produce a report on a daily basis. We call it the COVID report. And what it does is takes every single country in the world and looks at kind of an index of how good or how bad are things. So it has to do with number of cases, deaths, increases, decreases, all those kind of things. But it also includes things like traffic patterns. So from Google, you can get whether the traffic patterns today, how they are relative to a year ago. That is traffic getting back to normal. From Apple, you can get footfalls. That is how many people are moving around. So we combine all that data to come up with is how well or badly is the country doing on COVID. That's one dimension. The other dimension we look at is how well are these countries prepared to deal with the crisis? That is financially, that is, do they have the ability to take on more debt? From the healthcare systems, how good are the healthcare systems? Things like that. So we put all the countries on these two axes. And three of the countries that come off extremely well on this are China, Korea, and Taiwan. Because in all three cases, and I would add Vietnam to that as well, in all of these four cases, basically, you have a situation where you've had very few COVID cases, and they've done a very good job of dealing with it. And on top of that, their ability to deal with it is also extremely good. And the two are kind of correlated, because part of the reason why they did so well is because they have healthcare systems which are very well set up to deal with this. And that's because all of these countries, the ones in Southeast Asia, especially North Asia, were hit badly by SARS, back a number of years ago. And so they set up stuff to deal with this. And so when this happened, they had all the procedures in place, which they executed on. And that's why essentially Korea, Taiwan, China, and Vietnam did extremely well. That is, everybody was masked right away. Again, those are cultures where people wear masks even when they have a common cold. So masking was something which happened almost immediately, with pervasively. They had testing and tracing, which was extremely effective. Now, it may be difficult to do that in a Western country, because they're quite, invasive in the way that they basically have done that. But at the end of the day, it worked. So that's kind of one end of the spectrum. On the other end of the spectrum, you have countries like Brazil or India, which have done a rather poor job, because A, they're poor countries to start with. They didn't have the wherewithal. They don't have the public health systems to deal with that. And you have populations which are in very close proximity because of the population densities in the cities, in the slums of Bombay and in the favelas in Rio. So again, those are countries which have done much worse. And they're not running good public finances to start with. So therefore, their ability to stimulate the economy is just much worse. So you kind of look at both of those things, and that goes into our decision-making process as to, which country should we be putting money into.
It seems like forever straddling frontier to emerging markets and never quite getting to that next level would be the part of the world, LATAM. You mentioned one country where I could go back decade after decade after decade that looked like it might have been poised, but never quite happened, in Brazil. You look at the volatility in Argentina. You potentially see promise in a Chile, a Uruguay, but such a small economy, Uruguay, it's probably hard to be impactful from an investing perspective. Nonetheless, what are some trends in what I'll call LATAM that you're seeing in countries that may show, although maybe short term, but a little bit of promise and hope?
Yeah, I think that all of LATAM, from a longer term point of view, is kind of attractive. I think that basically you mentioned, you didn't mention Mexico. Mexico, again, is a country that we think has done pretty well in the long term of kind of moving forward. Again, the current government, I don't believe, has done a good job of dealing with COVID, and that's why they're having quite a lot of trouble. But you're right. I'd say the countries that have done the best from a long-term point of view are places like Uruguay and Chile. But as you mentioned, they're pretty small countries. It's hard to really invest a lot of money. And even Chile's had quite a lot of issues with political riots and things like that. If you remember from about a year ago, where there were riots when they raised the bus fares. So there have been kind of problems even over there. I mean, in many ways, Brazil is really the big country in Latin America. And as you correctly pointed out, they've had good governments and they've had bad governments. And they had a terrific period of time in the 90s when they had a president called Cardoso, who came in with something called the Real Plan, which basically got rid of inflation. And they had 10 extremely good years. But then after that, the government quality has really deteriorated quite substantially. And that has led to, all kinds of problems. So as I said, you need to get in, you need to get out. You need to assess whether it's attractive right now. And that's how you got to think about it.
Yeah, actually, let's jump into one of the countries that I didn't mention that you mentioned. My audience may have heard me talk a fair amount about it before, relative from a United States position, and that's Mexico.
Sure.
Mexico has a beautiful country, tremendous natural resources, industrious people, hardworking, beautiful oceans, mountains, resources, all that I mentioned. Now, The current government is probably not my perfect cup of tea, but they've gotten along relatively well with Trump in the US. Potentially, it's such a great partner for the United States, perhaps even lower cost manufacturing than China. So, as we're going to decouple, which is inevitable to some degree, how much is to be determined from China, I would say India and Mexico look to be intriguing countries if we don't bring everything on shore, which we're not. Yet Mexico is another one, a little bit like Brazil. It seems to get some headwind, then always seems to stumble. Now, again, I know you're going to be more focused on getting in and getting out, but on the positive front, comparative to some of the negative that you might have mentioned, what are some things to look at that could turn positive in Mexico's direction?
Well, a lot. I mean, Mexico has a lot going for it, and I think one of the really good things it's got going for it is the free trade agreement with the U.S. You know
Yeah.
that, and it has benefited Mexico hugely. You know, I mean, whatever you may think of NAFTA and things like that, it had a very positive benefit impact on Mexico. You know, I mean, even if you look at illegal immigration, prior to NAFTA, you know, the number of people who used to come across the border, illegal immigrants who came across the border from Mexico, you know, was a pretty big number. In the last few years, that has been negative. That is, we've had a negative number of illegal immigrants coming over from Mexico, i.e., people have been going back to Mexico. So when Trump talks about the people at the border, those people are not Mexicans. Those are people are coming from Central America for the most part. And so that to me is a success of NAFTA, that there have been enough jobs created in Mexico, that there's work there for people. They don't feel like they have to come across the border. So I think that they are a huge beneficiary of the free trade agreement. And again, they will continue to be so, especially with the US-China decoupling. And you correctly mentioned that today, the cost of basically manufacturing in Mexico, especially for the US market, when you include transportation costs and things like that, may well be cheaper than China at this point, because Chinese labor costs have really risen quite a bit. And so yes, I'm very bullish about that in the long term. The question is, you know, in the short term, are they doing the right things or not?
Yeah, and they've been at best mediocre, probably less so on COVID than we would have liked to see. And you mentioned some of the countries that have really nailed it, mainly in Asia, partially exactly what you noted because of SARS. We'd like to hope that we're learning from these experiences as well. And perhaps inevitably, as we'll have more unfortunate incidents like this in the future and outbreaks, that we'll be better equipped. But enough of the negative. And yes, I mean, broadly, I'm bullish, I guess you could say, on Mexico, but concern over the the political issue and obviously other issues they've had from drugs and cartels and how that has played out inside the country. But if you were to ignore that, which I know is impossible, so many potential benefits, especially for the United States. So I find it to be very, very intriguing. Most people don't think of the word emerging markets when you mention Europe, but for sure, there are countries, and I'm probably going to take some wrong guesses, but if you had to single out some countries, Poland, I'm going to assume Montenegro is way, way too small. But what are some countries that may stand out as potentially on the right track?
So basically, if you think about the universe of Eastern European countries that are considered emerging, it's Poland, Czech, Hungary, Russia, and some of the other smaller ones, Slovakia, Slovenia, and places like that. And then you have the Baltics, you know, you have Lithuania, Latvia, and Estonia. And then Turkey, which is kind of on the border of Europe. And so it's not clear whether you consider it a European or a Middle Eastern market, but it's kind of halfway in between. I would say that right now, none of them look particularly, with the exception of Russia, none of them look particularly attractive. Again, coming back to the valuation issue, but also because in all of these cases, sadly, what we have seen happen around the world is happening there as well. That is the rise of authoritarianism. You know, that basically, if you look at Hungary, especially, and you're starting to, you've had that happen in Poland as well, where you've really started to get some real authoritarian tendencies, which isn't really great for investing. You know, so. You know, and the same is true in Turkey. Again, certainly Mr. Erdogan has become a much more, you know, authoritarian person than he used to be. And so again, I'd say at this point in time, with the exception of Russia, we don't have a lot of money in the region.
Yeah, you mentioned a country that we brought up a couple of times, Estonia. I mean, very, very small from investing in a public company perspective, doing very intriguing things in blockchain, I will add, and even citizenship to some degree.
Mhm.
A country I'd keep an eye on. I think there's potentially some hope and promise there, but from your perspective, they're just so small relative
Right.
from an industry perspective. And, we mentioned one of those countries in LATAM that for US citizens that are looking for either dual citizenship or opportunities for flexibility, Uruguay in
Mhm.
LATAM, it's not going to be great from an investing perspective. It's too small, but it's very, very stable, especially by LATAM standards. Very interesting to kind of take that look around the globe. Now, well, there's a couple we haven't mentioned, but one that has been frontier forever, and that's going to be Africa. Do you
Mhm.
see? I know that Chinese have been active in Africa. Some could argue good or bad. Are there some countries that are showing promise to moving up from frontier to emerging markets?
Well, you have a few countries which are already considered emerging on the African continent. So if you think about South Africa, obviously, and then you
Right.
have, and then you have Egypt. So those would be the countries that are considered already, parts of the emerging markets. And then once you get past that, then you have kind of these East African countries like Kenya, Tanzania, and Uganda, all of whom have actually done fairly well, in terms of they're very small in terms of the market size. But they've all done actually fairly well. I'd say that group of Eastern African countries has done fairly well. In West Africa, obviously the biggie is Nigeria. Nigeria, unfortunately, has been plagued with, as I'm sure you're familiar with, a lot of problems, political and otherwise, and
Mhm.
corruption. And so therefore, when I first started investing in emerging markets in '93, Nigeria was in fact considered an emerging market. It was not considered, a frontier market. It is considered emerging market. It's a huge population. It's a giant country in terms of population, by far the biggest country in Africa. And it has some fairly well-developed industries and fairly big oil industry as well. But unfortunately, from a development point of view, it has really suffered quite a bit. You mentioned the Chinese investment into Africa. That's been an interesting factor uh, because they've really poured quite a lot of money into railroads, roads, lots of other, a lot of infrastructure and things like that. Interestingly enough, I'd say that the Chinese money serves really two purposes. One is a political purpose, because clearly they want to build alliances and relationships with people around the world as they kind of rise and take on the US kind of as a role of a global hegemon. Clearly, they're trying to build, connections, and it has paid off for them. So, for example, they now have a military or a naval port in Djibouti. So now on the African continent, they have a permanent naval presence. So it's paying off for them in certain ways. The second dimension is that a lot of the infrastructure that the Chinese have built on the African continent is actually serving them in terms of materials. That is, basically, Africa is very rich in minerals. And so a lot of the infrastructure has been to mine and transport the minerals to the ports. So they've poured money into ports, roads, railroads, and things like that. So again, it benefits them economically as well.
And I'm just thinking back to when you started in kind of that earlier to mid 90s, and especially even an era right before that. Investing in emerging markets it was hard. And being country specific would be incredibly hard. You had the rise of ETFs, of country specific ETFs. There's
Mhm.
more opportunity than ever before. But what are some of the biggest trends that you've seen in 27 years, going back to the earlier 90s to now? Uh,
Mhm.
and is more information and resources, I'm going to always
Mhm.
say it's better, but uh,
Mhm.
I don't know. When is it not? And when does it so called make the market more efficient?
Well, I would say that as somebody who picks countries and stocks and things like that, it was easier to win back in the '90s because there weren't a lot of other people, and there weren't a lot of people who had good data like we did. We spent a lot of time, collecting and processing data, and that was a big part of our edge. It's kind of like an arms race, as people get better and all that. It leads to greater market efficiency, but clearly it makes it harder to win at the game for people like us.
For sure.
Um, in terms of the trends that we've seen, back in the 90s when I first started, uh, by and large, people didn't invest in emerging markets. And I would say when I went to meet with potential investors, or half of them threw me out of the office saying, I'm not interested in that kind of place. These are terrible countries. I'm not interested in investing there. I would say that's not true today. I'd say that pretty much everybody recognizes that emerging markets is an interesting option. Plus, when we got hired in those days, typically, and again, we manage money traditionally for institutional clients, a lot of family offices and a lot of foundations and endowments, especially. Uh, at that time, they would have one emerging manager like us, let's say, and we would kind of be the entire spectrum of their investment in emerging markets. Today, what you find is that a fair amount of fractioning that has occurred, where you will find amongst the bigger institutions who we deal with, they have specific managers for India, for China, for the bigger countries. They have specialized managers for those, and they also tend to differentiate between value and growth. So they'll have value managers versus growth managers, and they will have private and public. So they'll have, in some sense, a portfolio of emerging market managers who basically manage for them, as opposed to giving all the money to one person. So, and then as you mentioned, now you have a bunch of ETFs for pretty much for every country. So you have people who are individually making country decisions and buying and selling countries as well through the ETFs.
Yes, it certainly has changed quite a bit. And in terms of GMO is such an iconic and so well respected organization, again, many institutional investors, including family offices, have been active in GMO opportunities over the years, if not the decades. Talk to us a little bit about internally I guess it's two or maybe more opportunities inside of GMO where people could become investing through what you created and founded there in emerging markets.
Sorry, I'm not sure I understood your question.
What are some of the opportunities that you've adapted inside of GMO to be active in emerging markets? Has it been one or two investment vehicles? Is it more?
Well, within the emerging markets, we actually have three separate vehicles that we have. One is kind of the one which the strategy that I launched back in '93, called the Emerging Markets Strategy, which is basically the value-oriented strategy. We have another strategy that we call the Emerging Domestic Opportunities, which basically focuses on the fact that you've got domestic demand increasing in each of these countries, and it focuses on the companies that serve that demand. So it kind of excludes things like technology, it excludes commodities and oil and things like that, and focuses purely on companies that serve the domestic audience within these markets. Because if you look at a place like China, in the year 2000, you had 1 million cars that were sold. Today, you have something like 17 or 20 million cars that are sold. So the fact is that as these countries get richer, the demand for all goods and services increases dramatically. And so the idea of that strategy is to focus on the companies that serve that demand. In fact, an interesting anecdote I'd like to tell on that is that what we try to look for is what I would call near certainties. Let me tell you one interesting near certainty. Currently, less than 30% of the people in India use toothpaste. Why? Because they can't afford it. What we know is that right now, India's per capita income is about $2,000 a year. And what we know is that every country that by the time it gets to $4,000 or $5,000 per capita income, 100% of people use toothpaste. So if India grows at 6 or 7% a year for the next 10 or 15 years, you will have 1 billion people who currently don't use toothpaste who will be using toothpaste. Okay, that's what I would call a near certainty. So it's those kind of trends that we look for, and then we look to say, okay, are there companies that can take advantage of this, and should we be investing in those companies? So that's the second strategy. The third one is something that basically focuses on something we call the liquidity premium. Now, this one is more oriented to people who already have a bunch of emerging markets and are looking for kind of a very specific thing. What we found is that there is a liquidity premium everywhere in the world. That is, if you're willing to own smaller, illiquid companies, at some level, the markets reward you for taking on that. And so this focuses on these smaller and illiquid companies. Now, traditionally in the West, like in the US, people said, yeah, we'll own a small cap fund. We'll buy small caps as a way of getting at that kind of illiquidity premium. But what we found in emerging is something interesting, is that the premium that you capture is not really for the smallness. It has to do with the liquidity rather than the smallness. The smallness is a proxy for illiquidity. And so if you can have the patience to basically hang on in difficult times, there's interesting rewards to be had by holding on to buying smaller and illiquid companies. And so that's the third strategy that we have.
Yeah, Arjun, that was very insightful and a great little anecdote there that you gave us. I didn't know that about toothpaste.
Well, the same thing is true for all kinds of goods and services. I mean, we can, I mean, just as another example, we invested back, I believe it was in the year 2000, in a company that made sanitary pads in China. Same thing over there. Again, you have the same kind of phenomenon where you get a small percentage of the population, typically below $1,000 per capita GDP, women cannot afford disposable products. By the time you get to 2,000 or 3,000, basically 100% of women in a society are using disposable products. So again, those are the kind of trends that if you can identify them, and they're not that difficult to identify, then if you can find companies who are in that space and are reasonably priced, becomes a very interesting proposition.
Yes, it sure does. For those that would like to learn more about some of GMO's solutions, how could they learn more about emerging markets at GMO? Is there someone they could connect with? Is there an email? Is there a specific website?
Yeah, just gmo.com. I think we've got a pretty nice website. And again, the thing I like to joke is that, people say, GMO, is that having to do with genetically modified organisms? And when I tell them that I work for GMO, I said, well, you work for genetically modified organisms? I say, no, I'm just the Western distributor.
Yeah, that actually crossed my mind. I'm not surprised that some people would think that, but it helps when you're known by that great acronym GMO, and GMO.com couldn't be any easier of a URL and website.
Sure. Yeah, and we have a lot of content on our website, which has to do with, again, for those of you who are not familiar with GMO, we actually produce a lot of good thought material about how to think about investing from a broad point of view, how to think about various issues. And a lot of that is basically available on the website. So if you just go to the website, sign up for it, and that's pretty open, and anybody can sign up. And there's a lot of interesting reading material there, especially about asset allocation, which I think we're particularly well known for.
Yes, of course. And GMO is a great organization. We've had Jeremy Grantham both speak at FOA events before, and relatively recently, I had a discussion with him on this show on climate change, which was a lot of fun. I learned a lot. He's incredibly passionate about it. So that was wonderful. Well, Arjun, it's been tremendous having you on. I really, really enjoyed our discussion. I wish we even had more time, but in a little less than an hour, shockingly, we got so much done, but certainly more on the table. Like you said, because of the volatility, I could probably have you on every even 4 to 6 months, and there's going to be just something so interesting and so dynamic, probably good on one end or bad on another, that was very different than it might have been 4 or 6 months ago. So we very much look forward to that. Everyone, I'm Angelo Robles. I'm the host of the Angelo Robles podcast, and I'm the founder and CEO at Family Office Association, a global membership organization dedicated to families of wealth and their family offices, providing significant amounts of original proprietary content and thought leadership, hosting hundreds of digital programs, and one day we'll incorporate going back, I hope, sooner rather than later, to physical events, which are a lot of fun, and the serendipity of bumping into amazing speakers like Arjun, who we hope to invite to that, and your fellow peers as successful investors and families, does make that very quote-unquote unique. But we've been adaptive, very digital, doing a lot of new master classes, as we call it, both some live and some pre-recorded or digital as downloads for our members. So you could find out about us on our new, I hope beautiful, I think it is, website, FamilyOfficeAssociation.com. And certainly feel free to inquire into membership for those that are not members. And my direct email is angelo@FamilyOfficeAssociation.com. Arjun, thank you so much for being a great guest. We appreciate your time.
Thank you very much. I appreciate it, and happy to come back anytime.
Look forward to that. Thank you so much.